Hey, what's up guys? Let's talk gold. Gold is usually used as a hedge against inflation, and also whenever markets are falling or crashing, people usually resort to exit from equities and go to gold. But then physical gold or jewelry is not the only option for us to invest in because they come with their own set of hassles. Are there better options? There is. I found one that is way better than physical gold for investment purpose, and that is gold ETF. What makes gold ETFs attractive? The very first thing that I can think of is you can buy gold ETF anytime and you can sell it anytime during the market hours, and it's very liquid. Man, I have to tell you, it's so liquid that there is almost no bid-ask spread. You can buy with very tight kind of liquidity, and if you look at the top ETFs that are in India, they are trading at almost like 50 to 60 lakh volume per day. And that's the most important aspect. Like if you want to liquidate it and if you have an emergency, you can liquidate it today and you'll get the money within 2 days. When your broker settles the money, actually. The second thing that is very beneficial with respect to gold ETFs is that, like if you have to buy physical gold, you have to buy at least 1 gram. But in gold ETFs, you can buy for as little as 45 to 50 rupees. True. Go and look up Nippon India Gold Bees ETF. It's selling at around 45 to 50 rupees per unit currently. And you can buy for 50 rupees like 1 unit, or you can buy for 5,000 rupees 100 units. So the major aspect here is that you don't have to spend 5,000 rupees per gram to buy 1 gram at a time. You can buy fractional amount also, but you can't do that with physical gold. So that is the major aspect that I can think of in terms of buying and purchasing and denomination. One of the most worrying things about physical gold is the aspect of transporting, safeguarding and storing. You either have to get a bank locker with payment of fees on a yearly basis, or you have to get a safe at your home and you have to safeguard it, and you're always on the lookout for like some thieves or some kind of issues that will happen that will take away your gold from you. But then that's not the issue with gold ETFs. What happens with gold ETFs is that these companies, they buy the gold themselves and then they keep it with some trustees, safeguarding procedures, and they insure the gold against any kind of theft, calamities. All of these things are taken care of for you so you can sleep peacefully. And they don't even charge that much for this. They charge a very small minimal expense ratio and minimal management fees to actually protect the gold for you and then also give you the upside of gold that the market has to offer. So that is, if that is not attractive, I don't know what else would be. Because for me, if I have physical gold, I have to deal with the hassle of storage and all. I don't want to do that. Also, when you buy physical gold, you have to pay above market price because the seller has to make a profit, and you also have to you have to pay making charges. And when you sell the physical gold, you will get a haircut on the selling price because you won't get the market price, you will get less than the market price. But with ETFs, that's not the case. You get the actual market price. Not actual market gold price, but then with a little bit of tracking error, you will get a better price than the actual physical gold price. So in that scenario also, gold ETFs have a better investment aspect because they don't have that much tracking error as your physical gold purchase and selling price. And another major benefit is that since these ETFs are backed by physical gold that is stored in their lockers, they actually track the value of physical gold very closely. You don't have to worry about them having very wide discrepancy from physical gold because they're not actively managed. They're just assets which are gold underlying the actual ETFs which track the actual gold price of the assets that they hold. So you don't have to worry about that either, and you get a better price in most of the cases. This video will not be complete without talking about sovereign gold bond. Sovereign gold bond has a holding period of 8 years with the facility to sell after 5th or 6th or 7th year. But then you have to hold it that long to get the capital gains benefit that it offers. Otherwise, it's very similar to ETFs. You can sell it even before 5 years, but then you have to pay the capital gains tax. And even though you get the interest rate, if you are selling it at a loss after 5 years, there's no point in that. And in terms of sovereign gold bond, the liquidity is so bad. It's crap. You will have spreads of around 100 rupees or 150 rupees at most of the times. And there'll be hardly like 100 or 200 buyers and sellers at bids and offer. So it's not a match at all to gold ETFs in terms of liquidity. Which ETFs should we prefer to invest in gold in India? I hear you. The very first ETF that you can consider is Nippon Gold Bees, which is the de facto standard for gold ETFs in India because it has the highest liquidity around 40 to 50 lakhs volume on average per day traded in the market. And next to that is Kotak Gold ETF and SBI Gold ETF. These have better expense ratio and better tracking error compared to Gold Bees, but then they don't have as much liquidity. They trade around 30,000 to 50,000 volume traded per day. So if you want to prefer, you can go with either of these three. Other than these three, when I checked other gold ETFs, they don't have that much liquidity, and without that kind of liquidity and bid-ask spread being tight, we don't have that kind of attractive nature to gold ETFs. So stick with these three if you want to go with gold ETFs. Okay. So I don't think there are any better alternatives to physical gold outside of gold ETFs and maybe SGB, because I would definitely advise you to have SGB as part of your portfolio for long-term basis on investment. But if you want a short-term basis investment for gold, then gold ETFs are your best option, hands down. Okay. So try it out. Go check out your broker's account and see what kind of gold ETFs are trading and check their liquidity and start investing. I think gold should be a part of everybody's portfolio, at least a very small percentage, to help with inflation as a hedge. So don't forget it and don't ignore it predominantly. Alright then, if you like this video, hit the subscribe button because I'll be posting more videos, and just smash the like button for YouTube algorithm, because obviously who doesn't want to do that, and it doesn't cost much for you to click on the like button, so go ahead and do that. Okay. Alright then, until next video, see you.